Welcome back, YouTube, to another video from the Wealth Catchers. Thank you guys for stopping by and checking in. As always, don't forget to subscribe, like, comment, let us know what you'd like to see more of. Give us any ideas that come on top of your mind while you're down there. And for this video, if y'all could, in the bottom of the comment section, the video today is going to be about the $100 investing blueprint, right? So starting off with the $100. So put down there in the comments what you think is a good amount of money to start with investing, and what do you feel like you need to start with investing in terms of dollar wise, and why do you think you need that amount to start? 'Cause a lot of people feel like I need 1,000, 5,000 to get started. Some of them need a certain number, right? But again, this video is going to be focused on starting with just $100 per month. But put down there what you think is the number that you think you need, right? So hopefully in this video we could debunk some myths, and we could show you the impact of what just $100 could do, right? So again, this isn't financial advice. It's just for educational purposes. And let's tap in. So this is all about showing the importance of small investments, right? So $100 could lead to a significant amount of future gains. And this is what we're going to be focusing on, is something called compounding, right? So compound interest, right? And doing something like this, $100 could be a lot for some people. For some people, it's not a lot, but I feel like it's a good number to start with. And in doing so, this could create, good habits, overcoming fear, because you probably aren't putting too much on the table. A lot of us spend $100 just on a night out or going to go grocery shopping real quick. So it's not too much to feel like you're losing anything or sacrificing too much, but also it's just enough to show you the impact, right? And then it's a very crucial step that could turn small beginnings into, something you probably didn't even think was possible, right? So I got here for you is a chart showing the returns over 30 years, right? So don't get shocked by the number. I feel like there's a lot that happens with people when it comes to investing, especially new people who are coming into it, new investors. They get this number and they have like 30 years just too long. The thing is, God willing, you got 30, 40 years in you again, right? Regardless of the age you are right now. You're 30 years old, put in your head, I got another 50 years of life, even more, right? You're 50 years old, put in your head, I got another 40 years. Because as we've seen it, technology is going to improve, healthcare is going to improve, right? People, as we see now, are living even longer. So don't I understand you want to live your life and all that stuff, but there's going to be a point in time where the old you is going to need this young person to come through. This person that you see right now in front of you today, when you look in the mirror, needs to come through for the 80-year-old, the 90-year-old you, right? And I get it. You feel like the 80-year-old, 90-year-old you can't enjoy the wealth or go traveling, stuff like that. But we want that 80-year-old version of you, that 90-year-old version of you to still be able to survive, right? Day-to-day necessities, to be able to pay for a roof over their head, to be able to put quality food on the table, pay for medical bills, right? To cover yourself, your spouse, or a situation may come up, emergencies, right? That the 80-year-old, 70-year-old you, 90-year-old you, 100, right? Year old you will be grateful and thankful that the 20-year-old version of yourself, the teenage version of yourself, the 30, 40, 50-year-old yourself thought of them, right? So that's what the whole purpose of this is, right? I know for a lot of people, 30 years, all those decades, that's a lot of time. The thing is, again, God willing, the time's going to pass anyways. Put yourself in position to protect yourself as much as you can. And I'm not saying it's easy. It's going to be sacrifices you're going to have to make. There's going to be things that aren't going to turn out your way, right? But doing something as small as this, right, could get the ball rolling, right? And then when things improve in life, you get some windfalls of cash or promotion, raises. This number could keep ticking up for you, right? So this is just showing $100 per month over 30 years, right, at a 7% rate of return. So all that is saying I'm putting away $100 per month all the time into the market. 30 years go by. On average, I got 7% return each year on my money, right? And it compounded. So when you look here, your total contributions was just $36,000, right? So over 30 years, you put away 36 racks. what that grows into is $113,000, right? So over 30 years, all you put in was 36K, and then that more than tripled, right? And that's just with $100. I'm gonna show you later on what it is when you put different amounts of money, right? But you gotta try to make that make sense in your head, right? Because it doesn't sound impressive for the most part, or someone's thinking, well, that's just 100K I'm gonna have at 60 years old or 70 years old. Again, this is with just $100. So imagine if you doubled, you tripled this, you put 500 away per month, right? And again, where am I going to find $500? Where am I going to find 200? Where am I going to even find 100? We're going to dive more into the stuff that you guys have access to that you probably don't even know. Your 401k is probably already doing the work for you. Your 401k probably already has 100K locked in for you 30 years from now. Now this extra $100 for another 100K plus that could come from you finding, space in your budget for it, right? So that the money's there. We just have to find it, be creative. We got to pull it from different sources. Maybe we have to switch jobs. Maybe we have to upskill, whatever it is it may be. But the money is there, right? We got to operate from a abundance mindset, not scarcity, right? So again, the chart showing that it's compounding, and then obviously the earlier you start, the better. The best time to start is right now. Don't hesitate. Don't I got to do this, I got to do that. The best time to start now. That's all I could say. Because the time again is going to pass you anyways. Time is not going to stop for you. Time's not going to care that you had a bad day. Time's not going to care your kid's sick or something's going on with work. Time doesn't care. It's going to keep moving. So the best time to take advantage of it is right now. So we're going to dive into choosing the right platform, right? Because if we call these are brokerages, right? So think of bank accounts, right? You have banks everywhere. There's brokerage accounts, right? They're the same thing except one, banks are for, depositing your cash, for checks, savings, stuff like that. Brokerages are for investments, right? So when we're looking for the right brokerage platform, we're making sure we have low fees or no fees. In today's day and age, it's pretty hard to find a brokerage that charges fees pretty much for anything. There are some that still do. You just gotta make sure you do the reading, make sure you understand what you're putting your money into, right? And just understanding what's going on. And sometimes some of the fees are justified. Some of them are is reasonable for me to pay this amount for what service you're getting, right? But if you can get it for free, obviously get it for free. If you get it for the lowest cost price possible, do that, right? Because at the end of the day, you want to try to get the best return on your money. Then ease of use, right? So you want platforms that are user friendly, easy to navigate, quick access features, right? And you don't want a whole bunch of like mumbo jumbo on your screen, right? You don't want to log into your brokerage account and feel overwhelmed, right? Because then that defeats the purpose of you even trying, right? If it's hard for you to make a simple deposit into the account, make a simple transfer of funds, and a simple buy and sell, you're definitely not going to care to even go into it more if it feels intimidating and overwhelming, right? So I do have some brokerages to share. I'm going to show them on the next screen, right? Show that we're looking into stuff that I personally used, how I feel about them and whatnot. And then the next thing that's important for a brokerage account is strong support, right? So you want to look for something that has good customer service, especially if this is your money, right? This is your hard-earned money on the line. Even if it's $100 to $1 million you got in the account, you want to be able to access and speak to a real person if something's going through. And for the most part, I've only tapped into customer service maybe once or twice. I got locked out of an account, needed access back. It was with TD Ameritrade before they got partnered with Charles Schwab. Very smooth. I got my account opened up in like less than 2 minutes. Just asking some questions about what stocks I hold in there, things of that nature, and then they were able to give me my access back, right? But you don't want to be dealing with the chatbot or automated system when you have that's your retirement account, that's your freedom fund, whatever it is to you that account is. At the end of the day, it's your hard-earned money. You'll be able to speak to at least a live person or have a process that's so simple for me to get back into my account. I got questions about X, Y, and Z. You can get some real good quality feedback, right? And also, I'm a real big advocate for making sure that platform has education, right? So a lot of times people go into the brokerage account, all they care about is depositing money, make my purchases, and they're out. I'm someone I like to be able to go to that brokerage account and read up on quality information. I want to see breakdowns of companies. I want to learn why this and that is happening. That brokerage could have a podcast I like to listen into. They could have reports on companies that I want to read up on, or they can have simple things as like what's the bid and the ask, right? Or what's volatility? What does volume mean? Breaking down basic market jargon for you to be able to feel more confident when you're reading a quote page, or just being able to tap into information and you know what you're doing. I like brokerages that offer that type of information to their customers, right? And simple questions. Hey, am I on track for retirement? Articles you can read on stuff that brokers that have their own like article factory, like their own um, information hub is great. You can tap in, read an article, see things, and it's just amazing for me when they offer those type of things versus just go in there and leave, right? It gives you a well-rounded hub, well-rounded information to go into and to look at and to see what you need to work on, what your shortcomings are, what you can aspire to, things of that nature, right? So now let's look at the brokerages. So choosing your ideal brokerage, right? So I have some quality names up here. Some companies that's been around for a long time. We got Charles Schwab, got Vanguard, Robinhood, Fidelity. So for all these, I'm gonna have links in the bottom in the description. The only one I've got to be transparent. It's gonna be an affiliate link. It's gonna be Robinhood. So how their process works, you sign up with them. It should still be I get a stock, you get a stock, but they have various promotions they run throughout the season, throughout the year. All the other ones, there is no, benefit to me or to you besides, just signing up for the account, right? But Charles, Robinhood, I'm gonna be transparent with it. There is an affiliate link down there that I'm gonna have down there for you to sign up through, right? But all these are good quality brokerages, in my opinion. Each of them have their ups and downs, right? So Charles Schwab, I feel like is very good. I've used it for a number of years when I had my Roth IRA set up with them. I feel like it's a pretty straightforward platform. It's one of them and Vanguard, I feel like have the least attractive user interface. So it's very straight to the point, very straightforward. There's nothing razzle dazzle about it. Where I do like with Charles Schwab, they have a slice program. What they allow you to do is invest $5 at a time into various amount of companies. I think it's all S&P 500 component companies. So that's pretty good. But Charles Schwab, they have a podcast section on there that give you market insights, ton of market information available on their website, and they have their own funds. So I do have a couple pages down. I should have it in there. Yeah, a couple pages down where if that brokerage account has their own funds or their own accounts in terms of like they have their own ETFs or they have their own indexes that you can invest in, I'm going to share that with you, right? So Charles Schwab is one of those companies that they have their own like Charles Schwab X, Y, and Z or Charles Schwab S&P 500, right? They have their own, which is good because then you don't need to you can still put $1 or $2 in there, or $10, whatever the amount is, into investment through them in that, right? Vanguard, pretty much the same concept as Charles Schwab's. They're both kind of like mirrors of each other, but Vanguard is well known for its low cost index funds, right? Charles Schwab does also have low cost index funds as well. That's a theme you're going to see across the board. There's a lot of companies now, a lot of brokerages that don't charge so much in terms of the fees for their funds, right? But there is a fee attached mostly to all funds, right? So that's another thing you want to look into and make sure you pay attention to. But Vanguard, their user face has gotten a little bit better over the years, but it still is kind of the old guard because this again wasn't something for to try to be appealing to the investor eye, right? It's kind of just like, hey, we're here to do this and that. Put your money in, buy your investments, get out, right? Then I'm going to go to the far right because Fidelity, still kind of the old guard, but they're who are pretty much have the most experience with, and I love them a lot. And they have upgraded their user interface on terms of the app side of things, right? Very nice, very sleek, very easy to use, whether you're doing regular investing, trading. I feel like they're a very good component of having everything mixed in there. And then in terms of information, they have this little AI bot kind of. If the stock's surging that day, it's a little lightning bolt button. Click on it. It tells you, hey, quick rundown why this stock's going up, why this is going down. They have some articles that don't have the pictures in there. It's just all straight reading, which I love that. And they pull from multiple sources. It could be Benzinga, it could be from Yahoo, it could be from whatever the name may be. But you have your stock, you scroll down, you can see news and click on it, and you can read a quick article about that. Something I do like about Fidelity having that option. And then last but not least is Robinhood. Definitely, if you've been around investing, you've been around brokerages, you've been hearing about it. Robinhood is one of the companies that democratized finance, basically, right? They're the reason why we have free trading now. The reason why we don't pay commissions on stuff, because back in the day, you needed to pay money to buy and sell a stock. So they made money on you on the front end and on the back end, and then you paid money to just buy the stock, right? So you had to pay a fee to make the trade. Then you need to make sure you had enough money to actually buy the stock. And then when it came time to sell, you need to make sure you had enough money to sell the stock as well, right? And on option trades too, right? So Robinhood was one of the first people to get rid of all that. How they make their money, a lot of people don't know. It's basically for order flow. So that's how they make their money off on the back end of stuff, right? But Robinhood, their user interface is more of a how can I say, they gamified it, right? So you can probably make a purchase, you see confetti pop up, this and that. It makes it more so game like, which some people don't like because this is obviously a serious situation. It's a serious money, people's livelihoods, stuff like that they put on the line, right? But I do like the fact that Robinhood hasn't introduced a whole generation of people who probably never would have invested and probably never would have thought of investing if this company wasn't around, right? Because I feel like they threw a blanket and bought in all these people that were either too intimidated by the Charles Schwabs, the Vanguards, and the Fidelities about the options available to them, understanding the jargon, stuff like that. And Robinhood just made it make sense. So Robinhood is definitely a platform I used a lot, still use it to this day, even though I probably don't have like a whole bunch over there and stuff like that, but I still like to go in there, see what's going on. I do keep up with the company, keep up with the stock. It's been great. I feel like they have a great turnaround story, and I feel like they're a company that's going to be here for a long time to come, like decades down the road. They also have retirement um, options in there now. They have Roth IRAs and I think regular IRAs in there. That's another thing too. When you get to a brokerage, you want to make sure you have taxable account options. You also want to make sure they have an option where you can open a retirement fund with them, right? So yeah, you'll get access to it at probably age 59 and a half or 61 and a half for the retirement age. I know they're always moving it around, but you want that option too, where you could, have your bridge account, your taxable account to take care of stuff that you may need to day when you get up there in age, and then you have your retirement account that you can tap into once that bridge account runs out, right? But yeah, Robinhood, I feel like it's great. All these brokerages right here. And again, there's more out there. There's E-Trade, there's stuff like Wealthfront and all that, but these are the ones that I've had the most experience with. These are the ones that I've actually have accounts with or had accounts with. I've actually made trades on. I've actually seen their options chain. I've actually, used information on there, read the charts, listened to the podcast, whatever for the most part they've had on there. I've used it, dived into it, checked it out. So pretty well rounded in all those, right? So that's why I put those four up there. Again, there's gonna be links in the description at the bottom for you all to tap into and sign up and make your accounts, okay? So we're going to open and fund the account. So obviously, look at it as like I'm opening a bank account just with a brokerage for stocks, right? So they're going to need to verify your identity. It's probably going to need, your driver's license, to on the stuff like your mailing address, things like that. Stuff that to verify your identity. Definitely going to ask for your social. So you gotta have that. And then most likely you're gonna need to fund your account. Obviously, what we're focusing on is the $100. But you can fund it with $5. You can fund it with $1, right? Some of them don't even need anything to fund it. You just open the account. But you are going to link your bank account or you're going to link your debit card account to it, whichever you feel like doing. Some of them do offer instant deposits. So in terms of like Robinhood, you can put $10 in. Instantly, $10 is available to trade. but you won't see the $10 taken out your account in terms of your checking or debit account right away. Usually it's like a day process of lagging. So after one day, you'll see the money come out. Sometimes like Fidelity, I could put something in there, let's say at 9 o'clock this morning. By 3, 4 p.m. in the afternoon, they'll take out the 10, 20, $50, whatever it is, right? So sometimes it's same day later in the day they'll take the money out, or the day afterwards, or maybe a couple of days later. And then some places do have a selling account too. They let like Fidelity, you can put the money there, you can trade with the money, but if you have to move the money between accounts after you transfer it one time, they have some days of, it can be 2, 3 days, maybe 10 days of letting the money settle. So the cash has to settle into the account before you can move it amongst the accounts. So let's say if I had a brokerage account in my name and I want to move money I put in that brokerage account today, I put $50, let's say, and I want to transfer that same $50 into my son's account, my brother's account. I would have to wait for that money to settle in my account, then transfer the money over to my son or sibling's account. In that process right there could be a whole 10-day process if I didn't just directly transfer from my bank account to my son's account. So that's an example of letting money settle, right? But also on the back end, here's the $50. You can instantly trade with it. You go buy Amazon or whatever it is right away, right? And then another big part of the opening and funding your account is selecting the investments. You do not just put your money into the account and then don't do anything else. A lot of times people put that stuff on automatic transfers, this and that, and don't know that they have to actually log in, go into the account, take said money, $50, $100, 1,000, whatever it is, and then go and click on a company, press the buy button. Just because you put the money in the account, the stocks are not being bought for you. It's not like your 401k when the money automatically goes to your 401k and the 401k automatically purchases the investments. When you have your own brokerage account and you have your own Roth IRA account, it's not done automatically. You have to go in there and select the names and click buy. Some people will go on for months, years, putting money in their account and they are not buying anything. So don't let that be you, please. If you're like, hey, every 15th of the month, I like to buy my stocks, cool, whatever. Log in, go buy your stocks. Go in there and actually press the buy button. So we have our investment choices, right? So we're going to start off with ETFs. So ETFs are exchange traded funds and they trade just like stocks, except they're like a basket of stocks, right? So they offer a lot of diversification. Usually they're low cost and, excuse me, they're ideal for investors, right? Looking to enter the market. So when you think of ETFs, think of like when you go to like the cereal aisle in Walmart, there's the whole cereal aisle. And then individually, there's different types of cereals, right? There's Cheerios, Frosted Flakes, Cookie Crisp. So those individual cereals, those are stocks, individual stocks. But the whole cereal aisle on aisle 12, that's the ETF. So you buying the whole aisle, and then within that aisle, there's a whole bunch of different cereals, right? So that thing about ETF is like that, right? You have this one sector, there's one industry of stocks that do all these different things, but you don't want to buy the individual stocks. You want to buy that whole sector. So energy, there's multiple different gas companies, multiple different companies that do all different types of stuff for energy, but you don't want to buy them individually. You just want to buy the whole energy sector. So you have the option of doing that with ETFs. So some key choices I've chosen for ETFs are VOO, which is the S&P 500 equivalent. We discussed that. If you go back to our market fundamentals video, we discussed what the S&P 500 is, top 500 companies in the US. So I feel like something like VOO, pick them because they're very low in fees and cost wise, and it gives you a diversified approach, right, for your portfolio, and it's a good reflection of US health and the economy of the US, right? And then we got something else called the QQQ, which is the NASDAQ equivalent, right? So it represents the NASDAQ. It's a little more volatile than the VOO, but it's offer great growth over time. So I guess it gives you your tech component paired with your SP 500, right? And then now, so that was ETFs. Now we're going to talk about indexes. So indexes have the same premise, right? They're diversified, and usually they give you better returns than doing individual stocks, right? And then less time is usually needed to manage these efficiently. So with indexes, they don't trade like ETFs or stocks. So usually you make your purchase, and those purchases will be done end of day. So like VOO or QQQ, it could be 10 o'clock in the morning. You want to go buy it real quick, 10 o'clock Eastern Standard Time. You go in there, put your $100 in, buy. Now for the index, 10 o'clock in the morning, you can still go put your $100 in, but it's not going to buy it right then and there. It's going to buy it at the end of the day, whatever that price is at the end of the day, right? So, same thing how I mentioned before in my past, how I do 10, 20% discount buys, 52-week low, 52-week high, is not going to really apply when you're buying the index itself, if you're buying an index fund, because the price from 10 o'clock to 4 p.m. could change drastically in that day, right? So that's why you would buy the ETF if you want to get a very sure, accurate price. But the indexes, the price is going to be always at the end of the trading day. That's what it's going to be trading at. But again, for this, we're not focusing really on so much pricing. We're focused on just getting your money in the market and buying, right? So indexes, put your money in there. It's going to be whatever the end price is for that day. And then here are some indexes I found for the equivalent of S&P 500, growth stocks, and international. So again, when I mentioned the brokerage itself has its own version of it, right? So Vanguard has its own version of the S&P 500. Fidelity as well does. Schwab does, right? For growth, Vanguard has their own growth. Fidelity has their own growth. Schwab has their own growth, and it's any for international, right? If you're one of those that like to tap into the international markets, here's your equivalents for them, right? And again, each of these do come with their own fees. There's something called the expense ratio. So put in your head, for every $1,000 I'm paying X amount, right? And then you want it to be as low as possible. You want anything that's, if it's 0.5% or more, I advise strongly stay away from it. Even if it's at 0.25% or more, so 0.25% or more, I would stay away from it as well. So Vanguard, Fidelity, and Schwab usually has a good amount of stuff that's under point 0.10. So, and again, you want to be careful with stacking these. So you don't want a whole bunch of them, because then you might mess around and get yourself into a situation where you end up paying 0.5% or 1%, and that's going to hurt your gains over time. So then we're going to tap into the automation and dollar cost averaging, that strategies that, because this could be very overwhelming for someone getting started into it. And then I'll give an example. Is my baby cousin. She started investing about a year ago. Yeah, I would say about a year ago. And I was throwing a lot of information at her. We were doing meetings and everything, and it became a lot for her. And I want to start with the very good part first. I'm super proud of her because she's turned 21 recently, and she's closing in on her first $10,000 invested in the market, and that's outside of 401k and all that, right? This is her brokerage and her Roth IRA combined, right? They mirror each other basically on the amount of money that she has in there, and I'm super proud of her because she's been super consistent with it. But her journey, for the most part, is like most people, doesn't have a good grasp or foundation of what's going on, wants to start but is intimidated, right? And seek some guidance, which we know is the guidance, but also you as the individual have to know, okay, what do I need, right? And luckily with her, we did have meetings, we did have conversations, and then she was able to let me know what was too much and what was she like more of, right? So me, as you probably could tell by now, very detail oriented, very by discounts, this and that, like price alerts, all those type of things. So again, lay the foundation out for her and showed her there's two sides of the game, right? So we started off with the side of that I'm on, and we did that for maybe a month, 2 months, maybe 3 months. We could say 3 months. And then very quickly she let me know, hey, I can't. be able to balance this with work and school, logging in. I know this is at a good price, or I bought this too late, or this and that. And then we come to turn out and find out that, hey, she doesn't need the price alert. She doesn't care about the screenshots, doesn't care about buying random days of the week, this and that. So me and her came with a plan where it's going to be okay. Every first of the month, she's going to make her purchases. Every first trading day of the month, she's going to make her purchases. So for the automation, she set up a certain dollar amount that goes to her brokerage account, her freedom account, and then goes to her um, retirement account. We call that the old you account, right? So she has a set dollar amount that she puts in there per month, and then she has a set day of the month. So that's every first trading day of the month that the market's open. She's going to go in there and buy her investments. And then I was like, okay, what investments? So me and her discussed. We picked out a core starting five for her, or the starting four. I think it's starting five we did for her. And so she has a list of five investments that she's going to be committed to, hold on to for the next 5, 10 years, whatever the case may be. And then told her, when it comes to that day to buy, go to Google, say, give me a random number 1 through 5. It gives her a random number. She goes to number 4. Number 4 happens to be, let's say, Amazon. She's going to go into her brokerage account, her regular freedom account that's taxable. She's going to purchase Amazon. Then she's going to go right over to her Roth IRA, do the same thing, purchase Amazon. And then she does the same thing next month. So that's a very simplified way of you being able to get your $100 to work for you on a routine basis, right? You put $100 into your account per month, regardless of what's going on. And then you have a day of the month where you make your purchase, regardless of what's going on. And then for her, she's been doing that diligently. And again, she about to surpass her first 10K. She's not too far off. I think she's like $2,000 away. So very proud of her. And that's obviously too with market growth as well, right? So she put her money in, and also the market is growing alongside with it, right? Sound investments and just staying the course, staying disciplined, staying consistent. So definitely proud of her. But that's a real life example of how you could do that same thing with your $100, right? So then some investing pitfalls we tend to run into, and then call these rookie mistakes, but they still happen to you, even the seasoned investor, right? Even someone who's been a part of the game for a long time, even someone who's been doing this for decades, they can still fall victim to these, right? It's just being able to be cognizant and aware of it and catching yourself in the moment, right? So chasing hot stocks, again, we're not going to be chasing hype. We're not going to be going after these companies that are flying high off the radar that profit off a short squeeze. We're not doing no Wall Street bets, what Reddit says, what this random post you found on IG, or what they're talking about on X. Like, we're not going to fall for any of those things, right? Same thing we had a few months back. We had the USAR stock go crazy, or rare earth mineral stocks go crazy. You was not paying attention to rare earth mineral stocks 6 to 8 months ago. You didn't know anything about this trade and the war trade going on with it in terms of who's stockpiling rare earth minerals. You didn't know anything about it. But as soon as you saw it mentioned here and there, you started chasing the stock and piling money into it just to get burned and hurt, right? Again, you put yourself in position, quality names at quality prices, and then you wait for it to fall into your favor and work out for you, right? Do not chase anything. Same thing with gold. Gold's going high flying right now. Don't chase it. You like, I don't even want to be mean, but you missed the boat, and it's fine because the boat comes back around. Your opportunity is going to come back around. It's going to dip 10, 20%. It's going to dip 5%. Whatever it is, it's going to come back to a price that you feel comfortable going back in and purchasing. But you need to stop chasing these stocks and stop chasing something that's $1, hoping it's going to flip to $6, or something that's $5 that's going to flip to $10. No, quality names, quality prices, and then panic selling. We have to stop looking into things, seeing our portfolios down, seeing that something you can put your $100 in right now, and you could be down 20% on Google next week. You see, you bought $100 and you put it all on Google, and you're down 20%. Your $100 turned into 80, and now you're panicking and you're gonna sell when realistically Google probably just had a bad report come out, maybe they're getting sued by the FTC, whatever, something crazy that isn't going to matter a year from now. And then that $100 could have gone up to $150 in the next 2, 3 years. So it's things like that that you don't let these short term noise, short term situations blow your account and make you sell at a loss. So we avoid panic selling at all costs. We do not let emotions overcome us. Yeah, you can look at the account, you can feel bad, you can feel down, but don't let it drive you to press the sell button, right? And lock in a loss you don't need to lock in. And then back to the ignoring fees. So back to the ETFs and the indexes, they all come with fees. Do not start buying. I like robotics. I like the rare earths. I like the transportation industry. And I like what's going on with space. And I like what's going on in healthcare. So I'm gonna buy 5 different ETFs. Not knowing 2 out of those ETFs each have an expense ratio of 0.3%. Another one has 0.5. Something else has 0.01. It's a great ETF to buy. It's damn near free. But it doesn't matter since you bundled all these up together, you're pushing a 1% expense ratio that you're paying in fees, right? For growth, that's probably not even going to beat the market. Because again, if you're going to be doing all this too, all it only really matters if you're beating the S&P 500. If you're not beating the S&P 500, it doesn't matter. That's another thing I have to highlight. It does not matter if you're not doing the education, doing the knowledge, and putting yourself in position to at least beat the S&P 500. Because being an S&P 500 is possible, but you have to know what you're doing for the most part, right? And if you're okay with just having market returns, just invest in the S&P 500. And then you can probably pair it with growth or whatever to get you your alpha and then get yourself your little growth opportunity, right? But do not go chasing things left and right and stacking on fees, chasing stocks and then panic selling. No, that's a recipe for disaster. We're trying to avoid that at all costs, right? And then back to what I was saying, the lack of diversification. I am someone that's a concentrated investor, but again, concentration comes with understanding and knowing what you're doing and understanding the risk you're putting yourself at. Newer investor coming into the market, learning diversification. You don't want all your eggs in one basket. You want to try to put yourself in a situation so you could see it through, right? So at least you could be invested for a couple years or at least, 2, 3 years to not be discouraged and get out of it, right? A lot of times you make all these mistakes in the beginning, you get discouraged and then you fall out of it, right? Then now the market's out of favor for you the rest of your life. And then you pass on those same traits and those same habits onto your kids and they never invest. So you got 2 generations lost that could have made, a ton of wealth because you got off on the wrong foot with the market and your relationship with it, right? So learning mindset. You always want to be a student in this game. Even for me, I'm still always learning. I'm still searching up topics. I'm still Googling stuff. I'm still, whether it's using AI, whether it's sitting down watching a video for an hour, 2 hours, whatever the case may be, I'm trying to learn something because there is always something to learn. You don't know everything. Don't be ignorant to think that you do know everything, right? And then patience. This is not a get rich quick scheme. You see people day trading, you see people who are making, thousands of dollars a day. Kudos to them, happy for them. But when it comes to investing, it is a long-term game. It's a game of putting away your dollars, quality investments, quality names, and waiting. That's pretty much what it all comes down to. And it's waiting. And then that cycle feeds into each other. And that's when you get the compounding. So patience is very key. So again, just to show you the different amounts. So this is doing $200 a month, which brings you to almost $250,000, right? So that from $100 a month, that got you to 116K. Doing $200 a month got you to $226,000 in that same time span, the same 7% um, annual return, right? So again, shows you just put in 72K, came over 226K, right? Now, if you did $300 a month, that becomes 340K. After that same amount of time, and all you put in was $108,000, right? and then that got you 340K. So again, it's about being consistent and waiting it out, right? And doing the right thing. And again, I know you're probably scrambling, trying to think, where am I going to come up with X, Y, and Z money? I did something on the side where I went into asked the question on Google. If you're getting paid $10 an hour, which is pretty much probably, some people probably still are, which I hope you're not. If you are, we need to make a change. We need to leave that job and go find something else that pays you better, right? And when you do find that job that pays you better, make sure they have a 401k. If the job does not offer you a 401k, one reason why you should be still doing it is maybe it's paying you a high enough wage to deal with that. But I'm a strong believer in you need to get the benefits and as much as benefits as you can out of the job that you're working. The job needs to have a 401k. They need to have a healthcare plan. They need to have something that's going to benefit you in your everyday life in the future you, right? That's a big part of why you're going to go work, right? Because they're getting something out of you. You got to try to get as much as you can out of them. So for a person that's getting paid $10 an hour, working a 40-hour work week, and if they're putting 6% away into their 401k for the whole month, that still equals out to about $104 a month, right? So even that person that's getting paid $10 an hour that could put away 6% into their 401k and do that for 30 years could walk out with 116K. Again, that's at $10 an hour. Some people could easily find a job at $15 an hour. Could easily find a job probably at $20 an hour, right? And obviously, we know reason why wages are going up because the cost of living is going up. I know. It's not getting any easier. But if you are going to get a higher paying job, try to get that 401k open, especially if that company matches, right? So there's a lot of companies out there that match. So let's say you put your 6% in and they match you 6%, that's 12% right there. So you have put your $100 in, that person was getting paid $10 an hour. Let's say they got the 6% in, the company matches 6%, right? So they put in their $100 a month, that company put in $100 a month. Now they went from, let me slide back, they went from doing $100 a month, right, to get that 116 after 30 years. Is the fact that their company puts in $100 as well, they automatically are at 226,000 if they stay there for the next 30 years, which most likely they're not. They're going to try to go do something better, increase their money, make more money, but it just shows that this number is just going to go up even higher, right? So that's what I mean where the money is there, right? So again, the person's making $10 an hour, 6% goes into their 401k. The company matches them 6% as well. Boom, that's their $200 a month right there that they don't even know is there and it's possible for them, right? And then boom, they have $250,000 after 30 years. So key takeaways and actions. Again, it's okay starting with what you can. If you can't do $100, do $50, work your way up to 100. Can't do 50, do 25, work your way up to 50, work your way up to 100. But $100 should be the baseline. And this is just saying $100 overall. So this could be your 401k and your employment plan and all that stuff. If you have that stuff going on and it's already doing $100, and then on top of that, you could do your own $100 post tax into a regular brokerage account and all that stuff, that's just more freedom for you. That's just icing on the cake, right? Because all this is for freedom. That's legit how you have to look at it. You have to look at, I'm doing this for the old me. I'm buying my time. I'm buying my freedom. Because you don't want to be in your 70s, in your 80s, still trying to figure it out, right? And you can go on YouTube. You go look up videos, the interviews that they have of people who have made mistakes. I highly, highly recommend whether you could talk to them or with technology we got now, if you could watch the videos and watch their interviews of the mistakes that older folks have made or regrets they have or things they wish they could go back in time and do. And I will say those videos alone, a wealth of knowledge, right? Stuff that they did the right things, went to school, good paying job. Some of them came on hard times. Some of them stuff didn't work out, emergency, spouse passed away, had to support the children, had stock in companies, sold stock, whatever the case may be, right? But they have quality information and life changing information that could help you today where you're at. And I feel like those videos alone are enough proof for you to take action. You have to take action. That's just what it is at the end of the day. So start with what you can where you're at. All right. Consistency matters. We gotta do this every day and day out. You gotta constantly make a choice for the future you, the future betterment of yourself, your family, whatever the case may be. You have to think about yourself, and that's where consistency comes into play. Educate yourself, make smart investment decisions. Again, don't chase hot stocks, don't panic sell, don't have FOMO, all those type of things, right? And then stick to your plan. Don't chase, don't have FOMO, don't panic. Stick to your plan. All right. So we're gonna see you next time. Again, there's some information at the end. Wealthcatcher@yahoo.com. Send me an email. If you want to send me something in private, I'll check it out, talk to you. Go to the website, wealthcatchers.com. Every now and then, I do have articles posted in there on the homepage, and there's also wealth of information, other stuff too, whether it's stocks, whether it's our monthly update list, insights on stocks, terms to learn. So different blog posts, definitely tap into that website if you want to learn some more information. And again, don't forget to catch and secure your wealth. That's what we're here for. And like, comment, subscribe, leave some stuff down there, and let us know what you want to see next time. All right. Appreciate you guys. Peace.